Welcome back to Financial Market Insights for Traders. I'm Sophia, your host, and today's episode covers one of the foundational aspects of successful trading: how to create a trading plan, a comprehensive, step by step guide specifically designed for beginners. It might sound like a cliche, but there's genuine wisdom in the saying: plan your trade and trade your plan. Successful trading isn't just about picking winning stocks or currencies, it's about having a structured approach, clear goals, disciplined risk management, and continuous learning. In this episode, we'll break down precisely what goes into building a robust trading plan from scratch. This comprehensive guide is designed especially for beginners, but serves as a valuable refresher for seasoned traders as well. Let's start at the very beginning: setting clear, meaningful goals and defining your personal trading style. Your reasons for trading are vital because they shape everything you do in the markets. Take a moment and genuinely reflect. Why exactly do you want to trade? Are you looking to generate short-term income to supplement your job, build wealth slowly and steadily over the long term? Or perhaps you're exploring trading as a potential full-time career. Identifying your primary motivation is key because different objectives require distinctly different approaches. If you're focused on short-term gains, day trading or scalping might be appealing, but remember, these require hours of dedicated market observation and rapid decision making. On the other hand, swing trading, where trades are held for several days or even weeks, or position trading, which involves even longer horizons, could better fit your schedule if you have other commitments or prefer a slower, steadier approach. Once you've clarified your motivation and defined your preferred trading style, it's essential to consider what markets or asset classes you will trade. Beginners are typically advised to start by focusing on a single market, be it stocks, forex, commodities, or cryptocurrencies, rather than jumping between multiple markets too quickly. Mastering one area allows you to develop specialized knowledge and trading insights, significantly improving your chances of success. For instance, if you're already an avid follower of economic news and fascinated by international finance, Forex trading might suit you perfectly. Currency trading responds strongly to global economic developments like interest rate changes, inflation announcements, geopolitical events, and even unexpected crises. Think of the recent volatility caused by central banks hiking interest rates rapidly amid persistent global inflation. By closely following such news and events, you can develop a keen sense of the market's likely reactions, improving your ability to anticipate price movements. Next, your trading plan must detail your exact strategy for entering and exiting trades. Will you use technical analysis, fundamental analysis, or a combination of both? Technical analysis involves studying price charts, identifying patterns, and employing technical indicators like moving averages, the Relative Strength Index, RSI, or the Moving Average Convergence Divergence, MACD, to make trading decisions. Conversely, fundamental analysis requires you to evaluate broader economic conditions, industry trends, and specific financial data to guide your investment choices. Whichever method you choose, specificity is essential. For example, instead of merely deciding to buy stocks when they're low, a good trading plan explicitly defines the conditions. You might state clearly, I'll buy XYZ stock if it dips and holds firm at $50 twice with increased trading volume, and sell when it reaches $55, placing a stop loss at $48. Clearly defining your entry, exit, and stop loss criteria removes guesswork and emotional decision making, leading to consistent performance. Now, speaking of risk management, it's arguably the most critical part of any trading plan, especially for beginners. Protecting your capital is far more important than chasing large, risky profits. Traders who survive and thrive long term always prioritize risk management. Start by establishing clear rules around position sizing. Most successful traders limit their risk exposure to between 1 to 2% of their total trading capital per trade. For example, if your trading account has $10,000, you should risk no more than $100 to $200 per trade. By sticking strictly to this rule, you significantly reduce your chances of experiencing catastrophic losses. It ensures that even a string of losing trades won't severely impact your overall trading capital, giving you staying power to recover and thrive. Next, Implementing stop loss orders is non negotiable. A stop loss automatically closes a losing trade at a predetermined price level, preventing small losses from becoming disastrously large ones. For instance, if you enter a trade at $100, you could place a stop loss at $95, limiting your loss to 5% of your investment if the market moves against you. Similarly, setting clear take profit levels is vital for ensuring your winning trades don't turn into losses. These predefined exit points help you consistently lock in profits and minimize losses. Another essential element of managing risk is maintaining a favorable risk to reward ratio. Aim for at least a 1-to-2 ratio, meaning if you risk $100 on a trade, your potential profit should be at least $200. This disciplined approach ensures that you can still achieve overall profitability even if your winning rate is not exceptionally high. Over time, a disciplined approach to risk-reward management can be the difference between long-term profitability and significant losses. Choosing a reputable broker and reliable trading platform is also a foundational aspect of your trading plan. Your broker acts as your gateway to the markets, making their reliability, regulation, and features critical. Start by ensuring the broker is regulated by reputable financial authorities such as the FCA in the UK, SISEC in Cyprus, or the SEC in the US. Such regulation provides you with crucial protections and reduces your risk of encountering fraud or unethical practices. Furthermore, look at the costs, spreads, commissions, overnight financing charges, and hidden fees can quickly erode your profits if not carefully considered. Also, confirm the broker offers robust trading tools, comprehensive educational resources, strong customer support, and user-friendly platforms. Brokers such as crystalballmarkets.com, for instance, offer beginner-friendly tools, educational resources, and demo accounts, making them an excellent choice for new traders. Speaking of demo accounts, practicing before diving into live trading is absolutely critical. Many beginners underestimate the value of trading in a simulated environment, yet it's arguably one of the best ways to familiarize yourself with market dynamics without risking real money. Use this time to practice executing trades, implementing your strategies, understanding market dynamics, and learning how leverage impacts your trades without incurring any actual financial risk. The demo environment helps you validate your trading strategy thoroughly. Keep track of your demo trades diligently, noting down exactly why you entered and exited each position. Analyze your results over time to identify patterns or recurring mistakes. This disciplined approach will help you refine your strategy before transitioning to live trading. Finally, recognize that creating and executing a trading plan isn't just a one-time task. It's an ongoing process of learning, adapting, and improving. Regularly keep a trading journal, meticulously recording your trades, market conditions, emotional state, and rationale behind every decision. Over time, your journal will offer powerful insights into your strengths, weaknesses, and tendencies. Periodically, review your trading journal objectively. Identify which strategies or setups consistently produce profits and which result in losses. Don't be afraid to adjust your plan as needed. The best traders are adaptable, consistently learning from their experiences and adjusting their strategies according to market conditions. In conclusion, having a comprehensive, disciplined trading plan is fundamental to your trading success. It guides your decisions, minimizes emotional mistakes, and significantly enhances your ability to stay profitable over the long term. Markets evolve continuously, influenced by current events like central bank policies, geopolitical tensions, and technological advancements. Your trading plan should evolve, too. Never stop learning, remain vigilant, and continue refining your approach. Thank you for tuning into Financial Market Insights for Traders. I'm Sophia, reminding you always to stay disciplined, trade wisely, and continuously adapt and improve your strategies. Until next time, happy and successful trading.